Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about AppFolio Inc. annual report. AppFolio Inc. offers a wide range of cloud-based services to the real estate industry in the United States. At its core, the company provides a platform that assists with accounting, reporting, marketing, leasing, maintenance, workflow automation, and communication services. The company's flagship products include AppFolio Property Manager Core, which offers basic functionalities for property management businesses, as well as serves as a system of record. Additionally, it offers AppFolio Property Manager Plus, which provides advanced features such as housing management, student housing management, complex accounting, and data analysis. The most premium offering is AppFolio Property Manager Max, which includes customer relationship management tools and full database access. In addition to its core products, AppFolio also provides a range of value-added services, including electronic payment processing, tenant screening, maintenance management, business optimization, resident services, and risk mitigation. These services cater to various stakeholders in the real estate industry, including property management companies, investors, potential residents, current residents, and vendors. AppFolio Inc.'s stock price has experienced a significant drop over the past year, exceeding 21.71%. The primary cause of this downturn can be attributed to two key events: the company's Q4 2025 earnings report and its 2026 revenue guidance. Despite reporting better-than-expected earnings per share, EPS, and revenue in Q4 2025, AppFolio's stock price fell due to its 2026 revenue growth guidance. The company projected a full-year revenue of $1.1 billion to $1.12 billion, representing a growth rate of 16.7%. This was lower than Wall Street's anticipated growth rate of 18.5%, leading several financial analysts to revise their price targets downwards. The stock initially saw a 5% decline in aftermarket trading immediately after the earnings report on January 29, 2026. The decline continued, with an article from February 3, 2026, attributing a 10.9% drop to AppFolio's mixed 2025 results and new 2026 revenue guidance. As of February 5, 2026, the stock closed at $177.36, a substantial drop from its 52-week high of $326.04 reached on August 4, 2025. AppFolio Inc. maintains a market capitalization of $6 billion, broadly in line with the industry peer group. AppFolio Inc. trades at a higher price-to-earnings ratio of 46 times and a higher price-to-book ratio of 11.75 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The balance sheet appears very conservative, with liabilities representing only 17% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth for a company are multifaceted and varied. One key driver is the adoption of subscription services and value-added services, which provide customers with unique experiences and opportunities for expansion. Additionally, innovation and technology play a significant role in differentiating product experiences and attracting larger property management customers. Customer retention and expansion are also crucial drivers of revenue growth, as well as scalable client service experiences and self-service automation. Long-term customer relationships, continuous service, and personalized account management all contribute to revenue growth. Furthermore, a modern marketing approach, industry thought leadership, and education can help attract new customers and increase revenue. The company's ability to compete in the marketplace and grow its customer base and revenue is also a key driver of revenue growth. The successful development and incorporation of AI technologies can also have a significant impact on revenue growth. Finally, an increase in property management, units under management, and seasonal increases in value-added services revenue due to higher leasing activities can contribute to revenue growth. On the other hand, there are several risks that could lead to revenue decline, including competition from technology providers offering point solutions, government regulations, and potential fines/penalties. Payment returns/chargebacks, theft/fraud/malicious activity, changes to payment card networks/bank fees/rules, interchange fee increases, noncompliance with payment card network operating rules, unfavorable laws, regulations, and tax changes, natural disasters, health epidemics, or other catastrophic events, cybersecurity threats and data breaches, and increased regulations, reporting requirements, standards, or expectations regarding environmental impacts. The changes in net income and profit margins over the years have been significant. Initially, there was a notable increase in net income, with a 12.7% growth under GAAP and 17.5% under non-GAAP on page 26. This trend continued with an increase of 7% on page 30 and $35,076 on page 33. However, the following year saw a decline in net income, with a decrease of 31.1% from 2024 to 2025 on page 40. The profit margins also underwent changes during this period. On page 26, both GAAP and non-GAAP operating margins decreased by 0.9 and 0.5 percentage points, respectively. However, on page 30, the effective tax rate increased from -35.8% to 12.5%, while depreciation and amortization as a percentage of revenue decreased from 2.5% to 2.4%. The interest income as a percentage of revenue also decreased from 1.8% to 0.9%. The profit margins continued to decline, with a decrease from 25.8% in 2024 to 14.8% in 2025 on page 40. This decline is likely due to the decrease in net income and increase in other comprehensive loss. However, there are indications of potential increases in profitability, such as the increase in net operating loss carryforwards on page 70. The company's financial performance is a testament to its ability to generate positive operating cash flow. The data from the past 3 years reveals a consistent trend of increasing net cash provided by operating activities. In 2025, the company generated a significant amount of $242.1 million in operating cash flow, indicating a substantial improvement over previous years. Comparison with the preceding years shows that the company's operating cash flow has been steadily increasing. In 2024, the company generated $188,159 in net cash provided by operating activities, which is a notable increase from the $60,283 recorded in 2023. This upward trend suggests that the company's operations are becoming more efficient and profitable. The substantial growth in operating cash flow over the past 3 years indicates that the company is generating sufficient funds to cover its expenses and invest in future growth initiatives. This positive operating cash flow is a key indicator of the company's financial health and stability, providing a solid foundation for long-term success. The company's debt level has undergone significant changes over the past 2 years. Initially, the total debt increased from $107,388 million in 2024 to $146,388 million in 2025. However, by December 31, 2025, this amount had decreased to $233,621. Furthermore, on September 30, 2025, the company entered into a new senior secured revolving credit facility of $150 million, with no outstanding borrowings as of December 31, 2025. In terms of interest expenses, there is limited information available in the extracted summaries. Interest expenses are not explicitly stated on pages 46 and 62, and it is also not mentioned on page 19. This suggests that the company's interest expenses may have remained relatively stable or unchanged over this period. Management's outlook for the company is centered on delivering value to industry stakeholders through a long-term growth strategy. The company prioritizes long-term objectives over short-term expectations, making product decisions that align with its vision. Despite expected revenue growth rate decline due to increasing competition and market maturation, substantial investments are planned to drive business growth. The company's financial health is also positive, with sufficient cash and cash equivalents to last at least 12 months. However, management acknowledges potential risks and challenges, including regulatory changes, cybersecurity threats, and competition from technological advancements. To mitigate these risks, the company emphasizes the importance of customer satisfaction, retention, and long-term success, as well as developing new product offerings and technologies. Management's strategy is focused on creating a sustainable business model that balances short-term needs with long-term goals. By prioritizing value creation for industry stakeholders and investing in growth initiatives, the company aims to maintain its competitive edge and drive future success. The company's financial activities have been documented in various sections of its reports. One notable aspect is the absence of dividend payments to shareholders. Despite this, the company has engaged in share buybacks, indicating a strategy to return value to investors through other means. This approach suggests that the company prioritizes maintaining control and flexibility over distributing profits directly to shareholders. The decision to forego dividends may be driven by various factors, including business needs or future growth prospects. That concludes the financial summary for AppFolio, Inc. Feel free to comment below, and I will be happy to answer them when possible.